Hi, it's Dre Griggs with Obsidian Wisdom. Next, when we talk about simplifying and streamlining your investments, we want to focus on adapting our investment portfolios over time. So there are three key reasons that we'll discuss today as far as reasons that we want to adapt our portfolios. And these three are normally going to be from the vehicle itself, so why it's important from your investments perspective. Number two is we're going to talk about it internally, things that are going on in your own life, your own micro perspective. And number three is we're going to talk about it from an external perspective, where we're going to talk about it from a macro perspective, where the whole economic conditions and trends, how that dictates the need to review your portfolio over time. So first, let's talk about it from the investment perspective. So when it comes to the investments that you're using, these investments are performing well or poorly at any given time. And as a result, the portfolio and the allocation that you have set for yourself, that is either and as a result, the allocations that you have set for yourself, for example, if you had a simplified 60-40 where you had 60% of your investments in stock market, 40% of your investments in bonds, and then for some reason, the way the economy was performing, 80% of your portfolio ended up in the stock market and 20% of your portfolio ended up in bonds, well, that is a different amount of risk that maybe doesn't work with your overall investment goals. And so whenever that happens, you would need to be confident and ready to go ahead and adjust and reevaluate your portfolio to where you sell 20% of your stock performance and buy 20% in the bond market, which freaks a lot of people out because technically what you've done is you've systemized your investments where you remove the emotion out of it. And now what you've done is you've sold high and bought low, which naturally is going to put you in a great position to be able to maximize the returns of your money. What most of us do is as the stock market is performing well, we get almost a little bit of a case of FOMO. We really want to put more money in the stock market. But if we're not looking at our asset allocation, then we may find ourselves now with 90% of our money invested in the stock market. Well, that's all fine and dandy, unless you move into a recession, which we'll talk a little bit more in number three. But if that was to happen, you could find yourself losing 20 to 50% of your overall stocks in such a rough time because you're getting ready to retire. You don't have the same amount of time that you normally do. And we want to protect ourselves from things like sequence of returns, which is a very fancy way of saying that when I first invested my money, I lost a significant amount of it. And because I lost a significant amount, I now have significantly increased the likelihood of me running out of money because the first year I lost so much. So it was almost the same as if I didn't have the money in my overall investments. It was almost as if I saved 30% less than I actually saved for retirement, which is why it's important for us to have that shift as we get closer to retirement. Number two, when you look at reviewing your portfolio from an internal perspective, from things in your own micro situation, if you had a death or a divorce, or you had a change in your income, or you paid off certain debt and inheritance, there are a variety of things that could go on in your own personal life that would change your asset allocations. Your asset allocation was uniquely designed for your particular unique situation. And because it was uniquely designed, as your situation changes, it may have changed the way your allocations were going to be created. For example, if you work 2 extra years, maybe you could have a more aggressive allocation. If you decided you wanted to retire 2 years sooner, then that might mean we need to have a more capital preservation approach where we dial it back a little bit. If you had two incomes planned for retirement and something was to happen to your spouse, well, that might mean that you have to make an adjustment to your overall lifestyle. It might mean that you have to downsize. It might mean that you have to change your investments around. You normally want to be able to take a look at your overall asset allocations and make sure it makes sense for your unique situation. The third is from an economic perspective, and we talked a little bit about it, where if your money is invested in a particular region and that region goes to war, for example, if you had investments in Russia and then Russia had the sanctions because of the war in Ukraine, well, you may have to adjust your asset allocation. If you had investments in Israel and because of all the battles in the Red Sea, it may not make sense for you to be invested in them at this current time. If you're invested in Ukraine and their grains, it again may not make sense for you to be invested in them at this time. When you look at the external events that are happening, you have to take a look and say, all right, can I stay invested in this? It might not have been that risky when I started, but now because of these economic conditions, maybe it's more risky. And so I can't invest in them anymore. You have to be honest with yourself when it comes to looking at these asset allocations. Why did I invest in these and have those situations changed? As the situations change, then we have to reevaluate them and see if it still makes sense. You may have thought it was a great time to invest in artificial intelligence and you put a portion of your portfolio towards that, which I'm totally fine with because it's okay to have a small portion of our portfolio towards hitting home runs where we're gambling and we feel that there are certain signs that this is going to be a winner, but we're not putting all of our eggs in that basket. We're not even putting a significant amount of our eggs in that basket unless we really understand the market to where my knowledge and my wisdom means that it's not as high of a risk for me. I actually understand this market very well. There are hedge funds that are very specialized. I know of a hedge fund that's very specialized only in the healthcare sector and is run by retired doctors. So it's not as high of a risk for them to be allocated and concentrated in one particular asset class because they have so much wisdom on the industry that they can recognize foolishness immediately. Now, if you don't have the time or the wisdom, then that's not necessarily the greatest thing for you to invest a large percentage of your portfolio in. But I'm still okay with you following your instincts and investing a pretty small percentage, let's say maybe like 5% towards that. But let's say something happened in artificial intelligence where the governments pass new laws in certain countries. Well, maybe if you're invested in an artificial intelligence firm that's in a country that has more stricter artificial intelligence laws, you would take a step back and say, okay, I can't be invested there anymore. An example that comes to mind is Warren Buffett. He was invested in a chip manufacturing company in Taiwan, but when he was looking at the geopolitical events, he felt like there was a lot of risk of China invading Taiwan. And if that was to happen, I don't know what would happen to that particular company. Would the Chinese government take it over? Would it be completely blocked and not allowed to trade anymore? Because of all that uncertainty, Warren Buffett said, this is now a higher risk investment. So I'm going to take a step back and sell all of my stocks in that company. You and I would review periodically and make sure that the situation that we invested in is still the current situation from the outside economic perspective when we're looking at our overall investments and their performance. Well, that is it for today's video. I'm always thankful for our time together. If you found value in it, go ahead and hit the like and subscribe button so you can continue receiving valuable insights on how to create your own wealthy retirement system. Until next time, stay safe and enjoy life.